and we're going to do a fantastic webinar today. We have with us today um, a great speaker. This is the first in our Masters webinar series, and today we have with us Master of Trading, John dacosta. So John was the visionary behind the currency and derivatives infrastructure at Wellington. He has some amazing stories to tell. As you know, Wellington's one of the largest asset managers in the world, but it wasn't quite so large way back in the day when John joined, and his knowledge and expertise really allowed Wellington to efficiently trade the trillions of dollars of currency and derivatives that they trade on a yearly basis. In that role, he oversaw the firm's interest rate, currency, and emerging markets trading, both in Boston and London. And he sat on many committees of the firm, including Dodd-Frank and the Counterparty Review Group, and actually has 25 years of trading experience. So welcome, John.
Well, thank you very much, and thank you for the kind introduction. As you mentioned, I've been in the business for a long, long time, and I've seen a lot of changes, and a lot of these changes are incremental in nature. So when you asked me to do this, it was really interesting for me to step back and look at these changes over a long period of time, and it really struck me that how we trade now has no bearing on how we traded when I started in the business way back
I bet.
In the day.
I'm going to tell just a quick second, just to let folks know, my name is Shireen Shermack. I am with Wise Trading Technologies, and we are in the midst of launch of our WiseRisk product, which is in currency hedging, which is something that John knows a ton about. So for our webinar today, we've got some questions for John, and John, if you want to sort of roll with that thought there, and then we'll dive into the questions.
Sure. So it's been really interesting for me to reflect on the changes in the marketplace over the last 25 years or so, and what we do now in terms of technology usage and so forth was really beyond imagination back in the day. And frankly, most firms could not do their job effectively without technology. And if you don't have a good technology platform, you're at a serious major competitive disadvantage on a lot of fronts. And I always tell people I was a great trader. No one really believed me, but my success in trading was really from the technology perspective and having the vision to build an infrastructure where we can compete with hedge funds and asset managers that were well ahead of us in terms of technology usage. So that to me was, in my mind, the value added that I brought to the firm. And so this is a very dear subject to my heart.
Great. Well, with that, can you tell us a little bit about why you initially chose to go into financial services as opposed to, other things you could have done with your backgrounds, like go into technology more deeply or become a CPA or something like that?
Well, CPAs are boring, so that was it. I started college late. I took my SATs when I was 21. And I was originally a history and philosophy major, and just realized, you really couldn't make a decent living at that. And so I started taking some finance classes, and I really loved it because to me, finance was the existentialist part of business. It's a bit abstract. You can be creative. It's not like a CPA, and I don't mean to be disrespectful to CPAs, but it's not as formulistic as a CPA or other professions. And I had a lot of room for creativity, which, unbeknownst to me at the time, and with the benefit of hindsight, that's what really appealed to me about finance. So I pursued that wholeheartedly and just fell in love with it, and just was fortunate enough to be able to get a break here and there, and ultimately ended up at Wellington, where I could express my creativity and really had a wonderful time doing that.
Well, what made you focus on the technology behind trading systems?
Well, back in the day, our technology consisted of an abacus, a handful of crayons, and a flock of carrier pigeons. And, that worked fine when we had a small amount of assets under management, 6 or 7 accounts, and, a handful of assets. But to really scale the business and to do it in a way that was accurate and efficient, because you want to do this without creating errors and so on, we really needed a way to leverage our work and our people to be able to do what we needed to do in a cost-effective, efficient, and accurate manner. And it was very clear early on that there's no way we would ever grow the global bond business using the technology we had at the time. To give you an example, in the early 90s, I requested an Excel spreadsheet because I had received a currency options pricing model that could only run on Excel. And the head technology guy said, well, we just bought the Excel program for our admins. They're going to test it out first, and if they like it, we'll roll it to trading. But these are some of the battles we had to fight back in the day. And I would manually adjust, create, and roll hedges. So imagine me coming into work on at 6 o'clock some Monday morning and getting these paper reports and using Lotus 1 through 3 to add up our currency exposure by currency, by account, based on previous day's closing prices. Again, that worked when you had 5 or 6 or 10 accounts, but as we grew and we had 400 accounts in the global bond business and $100 billion in a variety of different assets and risk profiles, it's just obviously not scalable. We used to fax FX trade instructions to banks. Now you can imagine how bad an idea that is, and you wouldn't get your fill until 24 hours later, so you had no idea what your risk was and how to manage that risk. So it just wasn't scalable, and for us to commit to being a world-class asset manager, we really needed to rethink how we did our business and how we conducted our business, how we accounted for risk, how we managed risk, and part of that is on the trading side, how to get that information quickly to the trading desk and let the traders do what they do best. That's move risk in and out of the market. And so we've invested a lot of time, political capital, a lot of energy into moving these projects forward. And and at times it was tricky because it's always worked, so why change it? And you always come across that type of attitude, regardless of what organization you're in. But sometimes you just have to dig down and fight the good fight because in your heart of hearts it's the right thing to do. And ultimately, I was able to convince people that we needed to take a different track, and it worked. In fact, I retired last June, and at my retirement party, one of my colleagues who was also a partner at Wellington came up to me after our retirement dinner, and I've worked with this guy for 25 years, and he said to me, "John, you were right, and you fought so hard, and you were right." So I was really flattered by that all these years later, because we've had some heated discussions over these things, and for him to acknowledge that on our way out was really special for me. So anyway, so the technology part allowed me, when I was trading, and my trading teams to be confident with respect to the information they have on hand, with efficiencies on the desk, so they don't take 4 or 5 hours to calculate hedges. We can do that in 2 or 3 minutes. We can do that based off current market values, not previous day market values. We ran a 24-hour trading desk, so all of that current information was vital to the business we ran, because ultimately their mothers and fathers and grandparents in these funds that we manage, and we've always taken our role, our fiduciary role, very seriously, and that's one element of how we were able to meet that goal, is control the risk, do it correctly, And that is one of the reasons that the global bond business took off from a couple $100 million when I joined to $100 billion when I left in June. And I take great pride in that because, now everyone knows who Wellington is, but back in the day, we're just more players.
Yeah. When you talk about back in the day, can you give us like a time range? When did
Oh, that's an embarrassing question. So I
80s? We're talking 80s, right?
no, this is even worse. It's a worse answer than that. It's early to mid 90s.
Oh, wow.
Yes, yeah. We
Yeah,
were
that's
really
right.
behind the 8 ball.
Lotus
Yeah,
123 was really the tool of choice for just about everything in the late 80s and early 90s. And when Excel came along, it's kind of funny because those of us who had used Lotus 123 still probably use a bunch of the shortcuts from Lotus in Excel, which aren't actually Excel shortcuts at all, but they
right,
recognize that everybody's transitioning over and they've never been able to let them go.
right.
But it's interesting
Well,
to me to I was just going to say that today it's fascinating to me how much of this stuff is still done on spreadsheets.
that's right because I think there's a mentality out there, and not just in the business, but anywhere in life that goes something like this. Well, it works, so why mess with it? And you can see why people have that view. The problem is to get out of your zone into a more efficient, risk-free zone. You really sometimes have to push the envelope a bit, and there's inertia in the current platform in a lot of places. I certainly have that at Wellington, and it's really doing a disservice to people running the trading aspect of it, and it's a disservice to their end client ultimately because you can't capture and manage risk as quickly as you should be, in my opinion. And especially in the world of currency, I remember being at a conference years ago with one of my colleagues, Ed, and we were listening to this portfolio manager talk about what a great job he had done on picking Australian banks, and his Australian bank performance was up 25% for the year. Unfortunately, the currency moved against him by 23%. So his return was 2%. And so I said to my friend Ed, I said, geez, Ed, the 2-year was up 3%. The total return on the 2-year was 3% for that year. Why not just park your money in a 2-year treasury bond and go home? So they were taking a lot of currency risk without knowing it. And, he had a great haul on the stock front, but leaked it away because he really wasn't focused on the currency aspect of it and how detrimental that can be to returns. And, that was such a powerful message when I heard that I brought that back to the firm and I said, this is happening out there. And it was such a powerful story that people can't argue against it. And, I think that story helped people think about what we did and how we did differently.
Yeah, I think that's such a great story. Not because it's a tragedy, right? And it could have been avoided to some degree. And I think it's interesting because people are very conscious of of trading currency differences now when they go into an investment, they actually think about it. But I'm not sure every fund has a completely a bulletproof plan in place for for currency hedging at all. So that's been kind of an interesting thing to watch as we talk to potential partners at WiseRisk, just how people are in very different states in terms of their implementation of currency hedging technology.
Well, I think that's absolutely right. And currency risk should be a deliberate risk you take, right? And you can get that wrong, obviously, but it should be a proactive risk. It should not be a risk based on default. Yeah. And there are a lot of organizations out there that don't pay attention to their currency risk. And I think that's that's really detrimental to how they conduct business ultimately, because it's a massively volatile and ironically liquid asset space. And so for people to take on that risk and not really focus on it, I think is problematic. And early on, we had the view that, especially on the fixed income side, that currency risk and rate risk are two risks that we can manage. And I think that's the proper way. These are holistic risks. And from where I sat, what was important for me is when someone like really strong personality on the portfolio management side came over and hit me on the shoulder and said, close down all our dollar-yen risk. I needed a way to do that in about 8 seconds. I couldn't wait 2 hours to look through paper reports, get my abacus out and my handful of crayons, sharpen them, and go to work, because they don't want to hear that you're still adding up exposure. And so, it's just not going to work with Rohanna. With some of the PMs I work with, you know who they are. I won't mention Haluk's name, but you know who they are. And so we really needed a way to say, okay, got it. I need 2 keystrokes to get this done. Boom, boom. Okay, now you free up the trader to do what they do best, to think about how to move that position in and out of the market, not sitting there adding things up and watching the market go against you while you're double checking your math. It's just not a way to conduct the business correctly.
Yeah, I think the difference between back then and now is that is that folks are aware of the risk. They just don't have the tools, haven't quite caught up. So with that, I guess I'd like to ask you how you think about the wave of financial technologies that's being developed now versus the ones you were dealing with 20 or 30 years ago.
Well, the technology now is from a trader's perspective, unbelievably sophisticated, because you can go to market very quickly from when you have a trade idea. Let's hedge our dollar-yen position, for instance. You can get all that information and you can trade it much more efficiently than you could back in the day, because now you've got algos and trading platforms where you can hit streaming prices, or you can ask for a request for quote. So there are a lot more tools available to move the risk as a result of technology, and also preparing the trade. And what I mean by that is making sure that you have the right exposure, the right amount to trade. And of course, when you get into cross-currency trades, becomes a little bit more complex as well. So when I think about doing, say, a $10 million trade back 20 years ago, that might have taken me from A to Z 2 hours. I'm exaggerating, but some period of time. When I left last June, we could put together a $1 billion trade in about 4 or 5 minutes, and that is dramatically different when you're trying to manage the risk. And that's because of technology. We're able to go into 500 accounts, pull out the information we need on the positions we've identified, put it on the trading desk, it goes through compliance, it's scrubbed, we know which dealers we can and cannot trade with, and then you're left with the trader doing their value added, which is moving that risk in and out of the market. And again, the technology on that side, with the use of algos and other trading platforms that weren't around, just makes it that much more efficient, because you're not leaving a footprint in the market. You want to be able to move your risk without changing prices as best you can. So the whole process is drastically different. And the winner in all this ultimately are the mom and pop investors that reside in each of these funds. And this is what we do this for. It's not to make my job easier, though that's helpful. It's really to protect investment returns for our clients. That's it. Because if you don't do that well, and the guy down the street they're just going to, they catch on quickly. They just pack up, they're mobile, and they move. So you can satisfy a lot of things by doing that correctly, including preserving your own business, of course.
Yeah, agreed. So do you feel like there's a bit of a mismatch now between the trading desk technologies and sort of the operational trading desk technologies? You know, algo.
Yes, I think I think about trading as you have, if I understand your question correctly, you have the professional trading desks like say Wellington, where we have 7 currency traders now in 3 time zones, 800 years of trading experience. They are really good at moving risk, and we're not alone, by the way. A lot of the funds our size have the same setup. I think the disadvantage for firms that for one reason or another, don't have the resources to roll out a desk like that, that they're behind the 8 ball. And so I think they are probably more in need of technological help in order to close that gap. And I think this is where the next phase of technology has to come from, is finding those clients that could really benefit from technology to make their business more efficient, more accurate, and improve investment returns at the end of the day. You can't run a business these days because without doing that correctly, because your competition is doing it, and that's never a reason to do something, but they are doing it well there, and they will have better returns as a result of being able to manage their exposure more quickly and more efficiently. That's the bottom line in my mind, right? And it gives you a chance to close that gap. There are a lot of boutique firms out there that don't have professional traders, but this is a cheap, quick, efficient way to close the gap against the Wellingtons of the world, the PIMCOs of the world. Pick any of these other big, sophisticated funds. And I think it's really a matter of survival at some point in time.
That's a great insight. But I have to ask you this. One of my favorite things is to ask people what currency volatility event they best remember, because I remember being in-house at an iBank when the Russian bond crisis happened, actually. So that was quite a day. It was like my second day or something like that. So I thought it was cool. So which currency volatility event has left a mark?
Well, I'm a lot older than you are, and I like to say that I've lived through 8 once-in-a-lifetime events. So there are a couple of ones that come to mind. The 1998 Russian ruble that you just mentioned, and I remember that vividly because I was hosting a college graduate on the trading desk that Friday, and a headline popped up on Bloomberg, and it says something like, the Russian finance minister says Russia will not default on their bonds, will not devalue the currency. So I looked over to this kid who was, just getting ready to, I guess he's a senior in college, and I said, looks like the Russians are going to default and devalue the currency. And he said, well, the finance minister just said they're not going to do it. And I said, precisely, they're going to do it. And of course, the rest is history there. Another big volatility event was in 1992 when sterling pulled out of the ERM, and it devalued by 20% very quickly. And of course, this was when ERM, the exchange rate mechanism, was in its infancy, and everyone was really jacked up about it, and ultimately led to the euro. And so that was in 1992. Fast forward 6 months later, I'm on a trip to London. I check in at the border control and at Heathrow. The guy looks at my passport and he says, well, what do you do for work? I said, I'm a currency trader. Puts my passport down, looks at me in the eye, and said, you're not one of those lads that wreaked havoc on the pound, are you? And I said, well, sir, it depends which side of the ledger you're on, doesn't it? And I thought the guy's head was going to pop. I could see the veins in his neck just dying to explode. But he let me through, so that worked out well. There was one other event back in the day, it wasn't that long ago. One of our portfolio managers is a Turkish national, and he had a big trade on in Turkey. And he was in Istanbul visiting family. And then he called one of our currency traders in the middle of the night. Fortunately, it wasn't me. And he said, you got to get into work right away. There's something going on in Istanbul. The guys in the black market are not selling dollars. I got to get out of my position. There's rumors the central bank's going to do something. So my colleague gets in his car. It's like 1:30 in the morning, cruising down Interstate 90 to get into work. He gets a call from the PM again. Are you done yet? Goes, no, not yet. So Ed, on his cell phone, right? On his cell phone, calls the Citibank trader in Istanbul and said, I need to move, blah, 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 close my position, boom, boom, boom. And then the trader said, well, geez, rates have just gone up to 100% overnight. You sure you want to do this? And that's, I got to do this. Just give me a price. Move the trade, close the position. Half an hour later, they devalued the currency by 30%. And that just shows you how sometimes you just live on the edge, and you really have to be on your toes at all times. And I think sometimes like technology is a way to help you to that point, right? Because in that case, Ed knew our position in his car, and he was able to close out the position and save this portfolio manager 30%. And think about that. That could have taken them years to get back when you're trying to do 2, 3, 4, 5% a year, right? And so that was a perfect example of where we dodged the bullet. We didn't know anything about the timing at the time. But what's important is that we were ready to act. We were prepared to act, and we did act based on the fact that some guy in Turkey couldn't buy dollars from a black market trader. Yeah. And wow. The probability of that happening again, I don't know what it is, but it's not zero. And so you want to be in a position where you just say, okay, get me from here to here in 8 seconds. I don't want to hear about 5 hours driving into work, getting paper reports, get the crayons out and start adding, because that window would have been shot and probably ruined the guy's career. And so, technology helps you implement that trade quickly, efficiently, as best you can. Absent technology, there's no way we could have managed that risk. Now, we had no foresight, so I'm not saying we look how great we are, but the point is that absent the technology, we would not have been able to even have a fighting chance on that trade.
Yeah, that's a great story and a great sort of cautionary tale. And with that, I am going to do a short word from our sponsor, and then we will take questions from folks who are dialed in. For those of you that are dialed in, if you look at your control panel on the right side of the screen, there's a little box in there that says questions where you can type in questions for John. So please do that while I'm going through these next couple of slides from our sponsor. So Wise Trading Tech is sponsoring our conference today. Their first product is WiseRisk, which is a cost-effective technology enabling businesses to participate in the global markets, but as we were discussing, they can focus on their core value proposition without becoming or hiring currency experts because we have better tools available today. So the idea is to not compromise the quality of their currency exposure management, but allow for great insight on it. And I almost feel like, given John's stories, we might not even need to discuss this slide, which is, what's happening out there in the market that made us feel like these were great tools for Wise Trading Technologies to offer first. And the reality is that, since the fall of the ruble in 1998, there have been a lot of black swan events, and any single event can be really catastrophic. We've seen firms go under because of decoupling of the Swiss franc and the euro. So there's just a lot going on out there, and it's great to be prepared with the right tools and technologies. So with that, I am going to go back to our questions. So thanks to those of you who took time to type them in. So our first question is, what was a piece of functionality, John, that was always on your wish list, but you were never able to get built?
Wow, that is a good one. I always wished that we had better systems to capture our options risk. That's always been a challenge because of the nonlinear risk parameters around options, and that's always been. I've always hesitated to trade options because we didn't have a good way to value our options exposure on a live basis because well, basically we couldn't get vol levels that were accurate fed in automatically. I don't know if that's changed or not. So that's always been a big wish for me. Another wish is that we weren't very good yet at capturing the cost of currency hedging. And what I mean by that is, currency will have a spot and a forward, and we didn't have a good automated way to say, if I do this dollar-yen trade on 3 months' time or a 3-month term, that will be X percent or 18 basis points or 400 basis points of cost over a 1-year horizon. So it's really fine tools like that, and I think it's one of those things that get on the wish list, but always sit at the bottom because everyone has to prioritize this stuff, and we're always going to go for the big ask and then hope we get these smaller, fine-tuned tools at some point in time. And of course, that just never happens because the priorities always change. I wish another thing we try to get is embedding currency futures with currency forwards, because sometimes those two are misaligned, and you might be better off trading the futures instead of a forward, depending on the currency. So we didn't have that tool yet. Again, these are fine tuning things that would have been really helpful, and hopefully the team will get them at some point in time.
Yeah, that was a great question and a great answer. And we are actually out of time for today, and that just flew by for me. So thank you so much, John, for joining us today, for answering questions, and for sharing your wisdom with us financial services history geeks.
My pleasure, and thank you everyone for calling in. I really appreciate it.
Yes, and for those of you with questions, there's an email address up on your screen where you can send any follow-on questions to, and don't forget to follow us on Twitter at @wise_risk. Thanks so much for joining us today, and have a great rest of your week. Take care.
Okay, thank you everyone.
Bye.
Bye-bye.